India's economic outlook for 2025 is shaped by both resilience and risks. According to the Ministry of Finance's monthly economic review, the report indicates that rural consumption is expected to remain strong, while urban demand shows mixed signals. In 2024, rural areas exhibited continued consumption strength, but urban demand's recovery remains uncertain, with the private sector's hiring and compensation trend playing a key role in shaping consumption patterns. Well, the report forecasts inflation to stay low, supported by strong agricultural output, alongside fiscal reforms aimed at boosting domestic consumption. A reduction in the policy rate by 25 basis points in February 2025, along with enhanced liquidity provisions, is expected to support growth. Furthermore, changes in the union budget are projected to improve the disposable income of the middle class, which should have positive effects on consumption. On the external front, the outlook remains clouded by geopolitical tensions and trade uncertainties. The report highlights a soft growth in merchandise exports, although services export have performed better. Despite these challenges, the Finance Ministry remains optimistic about India's economic resilience, underpinned by fiscal reforms and a focus on long-term development drivers. However, private investment has remained subdued due to global uncertainties. The Finance Ministry emphasizes the importance of private sector investment to overcome external challenges and sustain growth. If the private sector steps up its investment, it could significantly bolster economic growth. Yet the report notes that private capital formation has been slow in the financial year 2025, partly due to high global uncertainty and cooling demand for residential properties. Overall, while the domestic economy remains resilient, external factors like global instability and soft export growth continues to pose risks to India's growth trajectory in the coming year. And for more on this, we are being joined by Mr. Jayant Krishna, who's a senior fellow at CSIS. Thank you for joining us today on World Business Watch. So let me begin by asking, how vulnerable is India's economy to global geopolitical tensions and trade uncertainties, especially in exports? So we've seen that external factors like global instability and soft export growth are continuously posing risks to India's growth trajectory, and that is expected to continue into the coming year. And while we're discussing that, it's also important to note that the slow growth is partially due to the high global uncertainty and cooling demand for residential properties as well. So let me ask, how vulnerable is India's economy to global geopolitical tensions and trade uncertainties, according to you, and especially in the exports?
So if you look at, in India, almost 60% of the GDP is dependent on the domestic consumption. We are on a relative frame, we are less dependent on exports or imports and things like that, and also, but like any other economy, we are also vulnerable for global uncertainties. If you look at the way this year our GDP growth rate would be in a few days down the line when the financial year closes, it'll be about 6.5%. And there's a fair amount of balance between fiscal consolidation and growth. Sectors like agriculture and services sectors have done very well. Manufacturing and exports have the growth rate has come down a bit, so those are areas of concern. But very clearly, the supply chains all over the world today are integrated. If you look at oil supply, there is a huge dependency, and if there's a conflict in the regions which supply oil, which are oil-producing countries, it has a direct impact on the oil pricing and so on and so forth. There is a reciprocal trade fear. These are all issues to be concerned including that of India. If you look at the Global Trade Policy Uncertainty Index, in the Q4 of 24, which is the last full quarter that we had the data of, this index went up to about 237.4. WTO has also lowered the 2025, global trade growth forecast, from 3.3% to 3%, So I think these are all areas of concern, and the sooner, these global geopolitical conflicts are resolved, and and the trade, sanity prevails, I think it'll be good for the economy. Otherwise, I think we have a matter, it's a matter of huge concern for all economies, and India is no exception, despite it having a large dependence on domestic consumption.
Right, Mr. Krishna, and as you've said, agriculture is doing pretty well. And why is this rural consumption holding up better than, let's say, the urban demand? And what challenges are there which are influencing the urban areas?
So if you look at, our urban population as of now is about 37% of the overall population, right? Which is poised to grow to almost 40% couple of years down the line. But if you look at the basket of consumption in rural areas, largely things like, the food grains, the vegetables, mutton, and household consumption items, toiletries and simple toiletries, they typically constitute the basket of consumption in rural areas, which does not change if the monsoon is good, that offtake remains, robust. So that's the reason rural economy is doing well. And also in rural, if the unemployment, the wage employment continues to be a challenge, that's more in the urban areas and relatively less in the rural areas. So I think, and also the free ration, a lot of subsidies which these people get, a lot of freebies that people of the country get, a significant proportion of that goes into the rural area. So I think that all ensures that the consumption in rural areas remains, upbeat. And see, urban population, whatever we may say, we may be 37% today of the overall population. But what's the real purchasing power of that urban population? That, if you look at the market researches which are done all over the, by MNCs in India, the same about, 100 to 150 million people, that's about 10 to 15 crore people, only they are taken into consideration because they are the actual urban population which have a real purchasing power. So I think that's the difference. That's a reason for the difference between the consumption patterns in urban areas and rural areas, to my mind.
Right, Mr. Krishna. And that being said, what are the key factors holding back private sector investment despite favorable domestic policies?
I would say that, the ease of doing business has to improve. Our rank did improve to 63 from 120 something. But, the truth is, the regulatory cholesterol in our country continues to be, high. See, wherever there are online approvals from the government through governance initiatives, things have improved. And that is reflected in our ease of doing business ranking also. But wherever there is a person from the industry or business to government contact, I think that hasn't improved enough. So I think regulatory cholesterol removal or reduction is a very, very big priority. And also regulatory certainty is very, very important in our country. Fortunately, this government did resolve it a few years down the line. But, people still have memories of the retrospective tax, which became a major, major barrier for FDI to come in the case of Cairn and Vodafone. So I think these issues are very important. And to my mind, PLI, which has worked pretty well to attract some FDI into the country, I think it needs to be extended from, capital-intensive sectors to more employment-centric sectors, like textile, like leather, and so on and so forth. I think if all that happens, I think we have every reason to believe that, our private investment, both domestic as well as overseas ones, would improve. But obviously, we have to launch a war on ease of doing business in the country. That's very, very important to my mind.
That's right, Mr. Krishna. And that leads me to my last question. How sustainable is the low inflation outlook, which is driven by higher agricultural production and which is amid local and global supply chain challenges? What's your take on that?
So I think if you look at February 25 data, the inflation fell to a very, very low figure of 3.61%, which is even lower than the RBI target, And the main reason for that, to my mind, was the vegetable prices, they pulled down. And pulses and cereals, which showed a volatile trend earlier, I think in February they had a slight reduction. So I think these are good things. But sustainability of low inflation is something I think time will tell. To my mind, as we are at the end of March, in April, May, June, those months which have a huge amount of heat weather-wise. I think what happens to the vegetable prices and so on and so forth, that remains to be seen. So to my mind, the trend would continue because the economy is being managed well to control to contain inflation. But I would think that in the acute summer months, the inflation rate would increase slightly. It may not be. I don't think 3.61%, although it's a good news for all consumers, but I don't see it as sustainable.
Right. Thank you so much, Mr. Krishna, for joining us on World Business Watch and sharing your perspective with us.
A pleasure.